So this year for our 2022 investment guide, I wrote about the rest of the world's markets, which is a terribly unpopular discussion if you're looking at returns over the last 14 years. In fact, if you're looking at returns over the last 14 years, the U.S. and in particular U.S. large cap has been the best place to be in the world. There are a couple of reasons for that. First of all, part of that is a switch from basically 2001 to 2008, when for about 7 years, the rest of the world was the place to be. With the Great Recession, as it's called, of 2008, 2009, stretching into 2010, at that point, the U.S. started to emerge. Part of that was the U.S. reacted a little bit more forcefully in terms of monetary policy. And part of that is because the U.S. has a linked monetary and economic union, which means they can control interest rates and spending. And so that helped the U.S. in a way that in some senses in the Eurozone it wasn't as easy to do because their currencies are disassociated from their currency union is disassociated from the individual countries. So coming out of that we saw tailwinds for the U.S. in terms of its macroeconomic policy. The U.S. as well saw tremendous growth in technology services. Companies like Amazon, Apple, Netflix, Google, all kind of came into their own. And Facebook as well started making real money. And that helped drive up large cap stocks. The final factor was over the course of the time period, taxes for corporations came down as well. So all of these have kind of come together to support stronger U.S. stock growth. As these things have started to work their way through the system, we've started seeing the fourth thing related to all of those is the U.S. currency strengthened over that time period. Now, as we start moving forward into 2022, it seems like all of those kind of tailwinds have worked their way through, partially because of COVID and the aggressive U.S. response. I think the U.S. got a couple, particularly from a fiscal policy side, the U.S. got a couple extra years of reprieve. But as things hopefully in 2022 normalize even more with regards to COVID, and as well going forward into 2022, 2023, hopefully this doesn't last forever, the COVID situation. I think it is a good time to think about European stocks and Asian stocks as well. There are a couple of reasons. One, Asia and Europe are also drivers of those same technologies that we're seeing in the U.S. We're seeing in the U.S. a lot of talk about smart vehicles, electric cars. Tesla makes a lot of headlines. What you don't often see, though, is in the background, there's a German auto industry that has made its name through years and years in terms of innovating as well and improving and providing better engineering and better technology. So you shouldn't count out those industries for innovation on their side. The other, couple of factors, more macroeconomic that we're seeing or valuation related. First of all, the U.S. now, S&P large cap is extremely expensive. It's trading at about 165 trailing 20 years in terms of returns. What does that mean? That means that generally the stock market for the S&P 500 prices a stock at 15.5 times its earnings. Right now we're looking at, on average, 22.2, which is a pretty big amount. Now, lower interest rates here in the U.S. have contributed to that increased valuation, but there are lowered interest rates in the rest of the world. And so what we're seeing there is the rest of the world hasn't seen that same appreciation and is trading more on the ratio of 100 to 105% of 20-year earnings, price earnings ratios. So from a value perspective, there's something to be said there. The second thing is the U.S. In terms of GDP growth has had a pretty good stretch, but even over the last 14 years, the rest of the world did outperform it. And if you look going forward, there are significant predictions that the rest of the world GDP growth will outpace the United States. Emerging markets are a good place to look there and the growth. The other thing is innovation at our level and innovation at local market levels there are different. So improving banking profit margins at in emerging market banks will be a story and can help on the return of equity front and improve those markets longer term. Anytime there's instability in the broader world, as we've seen with COVID, as we saw with the Great Recession of 2008, 2009, you're going to see emerging markets struggle a little bit. But as the U.S. consumer reemerges out of the wake of COVID, emerging markets which supply a lot of raw materials, supply a lot of raw technology, will start to do better in those environments as well. And so you'll see overall world GDP growth. The third sort of factor is the U.S. dollar strengthened over the last 14 years. And so what we've seen as well, part of the separation has come from, if you look in local currency terms, certain indices have done fairly well. The French indices priced in euros have done better than the French indices priced in dollars. And if we see the flip side of the U.S. dollar strengthening, a U.S. dollar weakening, you will see that tailwind to those markets just from a currency revaluation standpoint. But a strong U.S. dollar also means a strong U.S. consumer. And what that means is these companies, many of them, sell to the U.S. market. And if I'm buying a car that sells for 30,000 euros, the provider can sell it in a couple of ways depending on whether the dollar is strong or not. If you flip it and you look at, one euro will buy you, about $1.2, that is a pretty strong euro. If you flip it and look and 1 euro will buy you only 1.1 euros, that's a fairly weak dollar. So if I'm selling a 30,000 euro automobile, that automobile in a strong dollar environment will cost less in the U.S. And that means that either I, as the manufacturer, can sell it for less and sell more of them in U.S. dollar terms, but still make profits in euros, or I can sell them at the same price as I was, but book more on my end. It also means that when it encourages Americans to travel. Now, obviously with COVID, that's thrown that into a loop, and I think part of the reasons we haven't seen the strong dollar start to modulate a little bit is, travel is still restricted. But as Americans start looking at this strong dollar, they start looking at trips to Europe and go, oh, this hotel, which once cost me, 500 euros a night and cost me, 600 US dollars a night, is now only $550. And I picked the $500 a night, not because that's where I stay, but nice round number so you can see the difference. And that will further encourage Americans to travel abroad. That means more hotels being rented, higher occupancy rates, better for local hotels. The kick-on goes from there as well. That means more people spending in restaurants. That means more people spending at museums, more people buying luxury goods or regular goods in France. And so that has a knock-on effect as well. So what I think we'll see is, from a valuation standpoint, hopefully, COVID will recede. I think we're all being very hopeful on that just for the sake of all of our sanity. We should see an ability to travel more, hopefully, and that will further help a lot of these economies. So it's been 14 bad years, and one of the old saws of the market is the market can stay wrong longer than you can stay solvent. But we do think there is a chance, and factors are starting to line up to see maybe that 14-year outperformance start to shift.